Hello, and welcome back to Bank Nerd Corner, the first Bank Nerd Corner of 2025. My name is Alex Johnson, and I am joined, as always, by Kiah Haslett, Banking and Fintech Editor at Bank Director. Kiah, Happy New Year.
Happy New Year to you. Happy holidays.
Thank you. Happy holidays to you as well. Any super exciting things to report? Did you get to take a break at all?
I did. I went to Atlanta for Asian food with some friends, and I practiced my chopstick skills because that is one of my resolutions in 2025 to get better at using chopsticks. Just hung out, read books, did a little home improvement. What about you?
That sounds lovely. Well, first of all, Kiah, let me say real quickly that while I understand your desire to improve your chopstick skills, I cannot support this resolution because you are abandoning me and leaving me alone as like the only adult who doesn't know how to use chopsticks. So I do feel a little more isolated now than I did before. But whatever, that's fine. I understand. My holiday break was actually also very culinary oriented because I got both a new outdoor griddle and a pizza oven for Christmas. Those were my two big presents, which is very unexpected and delightful. And so I spent the last 2 weeks basically making a ton of pizza and perfecting my outdoor pizza oven cooking technique.
Can you still cook outdoors in Montana right now?
If you're willing to shovel off the snow off your deck, you certainly can.
Yeah.
And actually I will say right around Christmas, it was pretty warm and actually not that snowy. That has since changed. But yes, you still can as long as you're willing to put on your parka and go out there. And on the griddle, I have found that my favorite thing to cook are smash burgers.
Yes.
So instead of smoking up my house and only being able to make like one at a time and the whole process being very annoying, now I have like a press that's like cast iron. I can smash it onto the thing and I can make like 20 smash burgers at a time. So I am basically training to be like a line cook at a diner, and it's so satisfying.
Well, I need to wish you a happy 3-year anniversary of recording this podcast.
Thank you.
Can you believe it?
I can't believe it. It is crazy. All right, so just to go back in the time machine for just a quick sec, happy anniversary to you too.
Thank you.
I believe that this whole thing started when I think I might have heard you on Breaking Banks. Maybe I think Henrik's got to you even before I did, but I was like, oh my God, that was amazing. And then I think I like maybe DM'd you on Twitter and I was like, hey, like some dumb banking question or something. And the thing people should know about Kiah, if they don't know this, is as soon as you express any interest in bank nerd stuff with her, she'll just like throw a ton of stuff back at you. So now I start getting like all these messages going like,
I just couldn't be cool about it.
And if
I just couldn't give like
you
two
be
sentence
chill
answer.
About it. Right. You couldn't be like, oh yeah, here's the quick answer, but I don't have time to deal with you. You just like gave me so much in response. And I was like, okay, well, this seems like a good way to podcast. And so we started doing the podcast and yeah, it's been 3 years. Isn't that crazy?
Yeah. I mean, we have like predicted several things, which has been really weird.
We have.
I like to think that this is, kind of a curious brainstorming, like an idea formation. And then it always surprises me when people listen to the podcast and then interact with the things you and I have said. And I'm always very grateful when someone shares that they're a listener. And, it makes it my job as being a reporter a little bit easier because I hope, people want to talk to me because they do know I'm such a big bank nerd. But it's been kind of crazy to be like, I didn't realize so many people are so excitable about this.
It's funny. I think in the age of the internet, online newsletters, podcasts, like anything can find an audience. And I feel exactly the same way. Like it's very heartening that I would do this podcast if it was just the two of us just nerding out on this and no one listened, but it's very gratifying that people listen. We get feedback. We had some great guests come on in 2024. We're going to do more of that in 2025. And Kiah, you landed on the exact right spot, which is this is a place for us to sort of lay out our thinking and our observations on what we're seeing in banking and in fintech. And then sometimes those loose ideas kind of coalesce into trends, events, sometimes very dramatic events that happen in the industry. Sometimes it coalesces into fun conversations or ideas that kind of get discussed in back rooms. So That's actually what we're going to do as a part of today's episode. So there was not a ton of banking news over the break. Not, I guess, terribly surprising. There was a little bit. And so I want to very quickly hop through a couple of news stories that we haven't talked about and that I haven't talked about with Mikula. So these are just like ones for you and I. And then you had a good question that you wanted to noodle on for a second. So I thought we could do that. And then I want to end by doing some, I'm not going to call them predictions necessarily for 2025, but sort of laying out our first principles thoughts on what we think might happen or might not happen in 2025. And we'll wrap up there, maybe with a little bonus personal financial management conversation at the end. Kiah, does that sound okay?
Let's do it.
Okay. So first story, we don't have to spend a ton of time on this, but I know you've looked into it and it's been a topic I've been fascinated by. The CFPB has formally sued Bank of America, Wells Fargo, JP Morgan Chase, and Early Warning Services, EWS, which is a bank-owned consortium. 7 of the largest banks, including the 3 I just mentioned, are co-owners of Early Warning Systems, or Early Warning Services, I should say, and they provide a variety of different services. But the reason that they and these banks were in this lawsuit is that they are the operator of the Zelle P2P payments network. And that was the subject of the lawsuit, essentially the CFPB alleging that the banks and EWS failed to protect their customers from fraud and scams, which has been a topic of intense industry discussion and debate for really the last 7 years since Zelle was launched in 2017. But certainly, I think over the last 3 to 4 years, really kind of around the pandemic. And since then, it feels like that's really when the conversation shifted into overdrive. So, Kiah, a couple things from the lawsuit, and then I'd like to get your reaction to it. First is this quote that I'm just going to read from Director Chopra, because I think it's interesting and speaks to some things we've talked about on the podcast before. We've put in place new rules to enhance oversight of non-bank companies, and we've issued nationwide consumer advisories about how funds stored in certain apps may not be covered by deposit insurance. We've highlighted how Apple's regulations have blocked banks from offering tap-to-pay functionalities, but we haven't been giving banks a free pass. So this, I think, could be interpreted perhaps as the director, Kiah, responding to you specifically, who have criticized the CFPB about expanding its regulatory perimeter and finding all these novel ways to pull more companies into its regulatory perimeter. It hasn't forgotten about banks, which sit at the very center.
Financial, consumer financial.
Consumer financial protection, one, and the 3 biggest banks in the country specifically. So this, I guess you could argue, sits very much at the center of the CFPB's mandate. And the crux of the lawsuit, again, is that these banks and EWS, which can be thought of as kind of a vehicle to manifest the wishes of these big banks and the 4 others that own them, basically alleges that customers lost $870 million over the last 7 years since Zelle launched because of these organizations' failure to implement effective safeguards around this P2P payment service. And specifically, the CFPB alleged a couple different things in its lawsuit. The first is that Zelle's lax ID verification processes have allowed bad guys to take over customers' accounts. I think that is a problem that has gotten better recently, and this is kind of a theme with EWS and with Zelle. It was rolled out in, I would say, somewhat of a hasty fashion, and over time they have added more safeguards and more improvements. So I think this is specifically speaking to sort of lax IDV controls early in the lifespan of Zelle. EWS didn't share data on bad guys who were receiving funds from customers who were scammed or when fraud was committed, allowing those bad guys to hop from one bank to another within the Zelle network. If their accounts were closed by one bank, they would just jump over to another bank. If you know the history of EWS as a data sharing consortium to prevent checking account abuse, you will find that particular claim pretty ironic, because this is like the one thing EWS is supposed to be really good at. They also allege that banks failed to investigate and follow up of the consumer complaints that they got in a timely fashion and failed to report fraud to EWS so that that data could be shared across the network. And then finally, that banks improperly denied customers' requests for reimbursement, even when presented with clear evidence that the transactions weren't authorized, which, again, for those who don't know, the sort of test under Reg E, which governs consumer disputes around these types of accounts and products, essentially the test is if you didn't authorize the transaction, then you are not liable for the losses. The bank is the one liable. So if there's account takeover, if your password is stolen, if someone gets improper access to your accounts, you're not liable. However, if you authorize the transaction, even if it's a fraudster who's tricking you into doing so, if you authorize it and they can demonstrate that, they are not liable, you, the consumer, are liable. So, Kiah, I just want to lay out a couple quick thoughts and get your reaction to these. The first, just for context, is that the CFPB has been investigating Zelle since 2021.
And that came up in the call as to why did this action come out when it did? Does it... does it signal Chopra's end days? And the response he gave in the press call was that this investigation has been ongoing since 2021. Yeah. And I don't know if the reason why he has to announce it now is the end date, but it wasn't new. It's not quote unquote new from the CFPB's perspective. Yeah,
I think that's exactly right. And it's part of a larger effort that I would say, like, the Biden administration and Senate Democrats who are sort of involved in banking and financial services have been focused on for a while. Obviously, we've heard senators like Senator Blumenthal, Senator Warren sort of rail against Zelle specifically. And it's a tempting target, obviously, because Zelle is owned by the big banks, so you can sort of, if you're a Democrat, kind of polish your anti-big bank sort of credentials while at the same time sort of polishing your consumer protection credentials. So it's a very sort of tempting target. In fact, the Senate Permanent Subcommittee on Investigations released a report on Zelle, I think in July of last year, kind of speaking about the fraud problems that exist on the Zelle network. That report came to very similar conclusions. I would imagine it sort of informed the lawsuit a little bit as well from the CFPB. So all of this is to say, to your point, Kiah, this is not a new thing. Well, I think the CFPB has been fairly criticized for rushing towards the end of last year and trying to get some stuff done, maybe in a haphazard fashion. Even though this is getting slipped under the wire, this is the result of years of work, I think, on behalf of the CFPB. So I think that's a very fair statement. From the bank's perspective, and I have heard some sort of whispering behind the scenes about this a little bit, they're really mad about this lawsuit. And I think if I was to sort of put on my big bank hat, they feel unfairly targeted by this. And I do think there is a little bit of truth to that, as I was just saying about, Zelle being a sort of politically convenient target. Cash App and Venmo have these same sorts of problems and scams, and I don't see them getting the same level of scrutiny. I think EWS would also argue that this problem is just blown way out of proportion, given the amount of overall volume that happens on the Zelle network relative to the amount of fraud. I personally don't think that really buys you much as an argument when we're talking about consumer fraud.
I don't know what, would they make then the argument that there is an amount of fraud that they would allow over their system? It's basically that, that actually is too much fraud. Right.
Yeah,
it's that. Just don't make that argument.
It's that old, the ideal. This Matt Levine talks about this in Bloomberg. The ideal amount of financial crime is non-zero. Right. That's true, but you never say that out loud, I think, is kind of the point. And so I find that argument to be maybe not the most persuasive, even though there is some truth to it. And then ultimately, I think the other thing that banks are frustrated about with this is that they are working, and I know this for a fact, behind the scenes very quietly at sort of an industry consortium level, and even working cross-industry with social media companies and telecommunications companies to try to reduce the instance of these scams and this fraud that's happening. And I wrote about this in my newsletter, but the L word is liability, right? As soon as you bring up liability, or as soon as you say, hey, you're, improperly not protecting customers the way you should be, as soon as you make it kind of a regulatory liability argument, everyone sort of shuts down and the ability to cooperate sort of dries up. And so I think that banks are probably reasonably frustrated that, like, look, we're trying to fix this. We're trying to fix this. You bringing this lawsuit makes our job harder and makes that type of cooperation less likely, not more likely. And we've actually seen a version of this playing out in the UK as well around the same issue. So I think that's the big bank viewpoint on this and why these three banks and EWS are probably not super thrilled about this. I have my own thoughts about why I don't necessarily agree with that. But before I get into it, Kiah, what's your sort of reaction to the lawsuit? What jumped out to you?
So you didn't touch on this, but it came up in the press call. The reason why these three banks were targeted for the lawsuit out of the 7 that own EWS is that 70% of Zelle transactions are run through these three banks. And so that is
because they're the ones with the biggest retail banking portfolios, right? Like this is where all the deposits are. Makes sense.
And so they're the power users of Zelle, of all Zelle. I also would love someone to tell me if EWS is a bank service company or not. All signs point to yes. I just never want that to be far from our minds.
I love that.
And I fraud has come up in a big way for me as a subject matter, because kind of I think there's really interesting questions around fraud and liability, and then the rules, Reg E and Z, that govern liability and the eras that they were written in and the financial instruments they were written for, and whether or not those are fit for purpose in today, the way money moves today. And as I was talking and thinking about scams and fraud and why those two things are different, why those differences are important, when do those differences matter? And then, to think that as we, in the financial environment where, Synapse can fail and Yada customers can lose so much of their money, and then legally the banking industry can just be like, this isn't really our problem. We don't have a liability here because our rules didn't allow for this to happen. And so this bad thing can happen to you because even though we gave you the pipes, even though we gave you the access, you can still actually lose all your money, and then no one's really responsible for it. And I'm not saying that's exactly what happened, but that's how you can kind of interpret Synapse. And you can kind of take that same logic and apply it to something like an EWS like Zelle. You can kind of say, I'm sorry you were fooled. And I'm sorry you didn't understand that Zelle, which is a product tied to your bank, will have different protections than a check might have, than your debit card, than your credit card, which also all bear your bank's logos, and different. And like, I guess, do we live in the world where we can just have this much fraud and scams running through our financial economy and our lives? And then everyone's just like, I'm sorry, and so when you mention the telecom companies, like, why isn't my number private, right? If my number has come to signal my identity, why can people spoof my bank and contact me? And then if I'm tricked because of a very elaborate scam, I am also without help. And I can unfurl on this so fast. The thing I always think about with Zelle versus Cash App versus Venmo is one of them is inside a bank and connects directly to a bank to another bank account. And then I really wish that when you say the big banks are taking this seriously behind the scenes and they're trying to collaborate and they're trying to work with like each other and they're trying to work with all the telecoms and social media companies, that's fine. I can believe that that's true. I wish that I felt like they were signaling that they are very, very upset that their thing they made for bank customers to send money to each other was being used for crimes. And they take it very seriously that some of them are receiving stolen funds.
Yeah, you and I have talked about this, and I think you were the first person who sort of made this point clearly to me, and it's a really good one, which is like, oh no, I was tricked into authorizing this thing. Was it a trick that I should have seen coming? Is it my fault that I fell for this? Could the bank have done more to stop me from falling for this? Like, so much of the conversation gets wrapped in the sending part.
Yeah.
But the part that I think is now being discussed more, and this was definitely part of the CFPB's lawsuit, and this has been sort of a focus of regulators and lawmakers more recently, but it's like the key point in a lot of ways is there's a receiving party on the other end, right? Like they didn't like run out of the bank, throw all the money in a car and like drive off, right? Like this is not that. This is the money being received in another account. And that account is by definition a part of the Zelle network, right? Yeah. And I said, given that 70% of the volume is these three banks, it's one of these three banks, I mean, more than likely, that has those accounts. And it's like, when you put it in those terms, what you realize is, oh my God, like criminals who are committing financial crimes. Now, again, maybe not like money laundering and the type of like sanctioned activity that FinCEN requires you to keep a close eye on, but like financial crime nonetheless, right? Like fraud is a predicate to financial crime is the way that people in government talk about it. They're committing fraud. They're committing a form of financial crime, and they have an account in good standing with you as an organization. That's a problem, right? Like that is as much a problem as people getting tricked. You could get tricked as a consumer, as a user of Zelle 1,000 times, but if the person doing the tricking on the other end can't get into these banks to open up these accounts, then the trick doesn't matter because you can't send money to the other party. So I completely agree with that. Max Levchin, the CEO of a firm, always used an analogy that I always liked when talking about the difference between BNPL and credit cards, which is like, he said, credit cards are like a chainsaw. And it's like, it's fine to build a chainsaw and to sell a chainsaw, but giving a chainsaw to anyone with no training and no warnings and no safeguards is irresponsible, even if you're not the one who accidentally cuts off someone's leg. And if it's their fault, it's still sort of your fault and you have some responsibility. So I completely agree with that. To go off of your point about Cash App and Venmo, the other thing that I just constantly want to remind people about, and I think it's really important context, is no one was asking in 2017 for P2P payments to all be real-time by default. We weren't asking for this, Kiah. Cash App and Venmo appear to operate in real time because the communication between you and I, when I pay you back for lunch, that communication layer is real time, right? So like, you know, hey, Alex paid me back $20 for lunch. He has satisfied his social obligation to me. That's instantaneous. But the money doesn't settle overnight. It's ACH. It takes 2 to 3 days. And by the way, for 98% of P2P use cases, it's fine for the money to settle in 2 to 3 days, right? Like if I have to get rent to my landlord tomorrow, or I'm going to be in default of my lease, that's a situation where I need the money to move in real time. But guess what? In that instance, both Venmo and Cash App offer an ability through the card rails for me to push money to an account in real time. And I'm totally willing to pay a fee to do that. That's how P2P worked prior to Zelle showing up in the scene. Why did the big banks and EWS make Zelle real time by default? Because the whole motivation for doing this was to compete with fintech and to counter position themselves against Zelle or against Venmo and against Cash App. So they made the crazy idea, in my opinion, of not just making real-time an option, but making it the default. That's how it works for everyone all the time. That has made Zelle a much more dangerous product to use from a scams and a fraud perspective than Cash App or Venmo. Now, I have my, qualms with PayPal and with Block about how they've operated their P2P services, and they've been much too comfortable with fraud and scams, and they definitely have some culpability here too. But Zelle being designed to be real-time by default and then sort of jumping us into this new world proactively, there's some responsibility that lies there for them. So I think that's one thing. And then the other thing you mentioned that I think is really an interesting thread to pull on real quick is you mentioned that like this sort of thing that they offer, this Zelle product that they offer, is sort of governed by Reg E, but isn't always necessarily treated the same way that other Reg E products like checks or debit cards.
I'm not the strongest Reg E person, but I'm just saying as like, okay.
I think it's true, right?
I need to disclaim that, okay.
No, because I think like what regulators like Director Chopra would say is Regi absolutely applies to Zelle just like it does to anything else. That's what regulators would say.
Apparently, there's some nuance. There are people making arguments both ways over here. But
there is, and I think to your point, I mean, you make a really good point, right? Regi wasn't designed for these products, right?
Yeah.
And so it was designed well before these products came into the market. In fact, I think it goes back to the 1970s, if I'm remembering correctly. And so that's very, very fair. But I think it's also been very clear to banks, even if they disagree or don't think it's fair, that Regi practically does apply in this case. And so they've always used this authorized, unauthorized line. That's what they've tried to hold on to. But there are documented cases, documented by journalists and reporters, and now documented in the report from the Senate subcommittee, and now this lawsuit of Zelle customers. I'll just give one specific example, which has happened multiple times, having their phones stolen in real life. So someone comes up to them, robs them, steals their phone, forces them to open the phone so that the bad guy can use it. And then they use Zelle to transfer money out of their bank account. The customer then files a police report. They get access to security camera footage showing the robbery. They have corroborated evidence showing that they were robbed and that the transaction happened at this time and it wasn't authorized by me. And then they get denied for their reimbursement requests from banks. You can have as nuanced an opinion you want about Regi and how it applies. That is clearly an unauthorized transaction. And the way I know that is if I call my bank and say, hey, my wallet was stolen, my debit card was taken, and someone used my debit card without me authorizing it, the bank, 99 times out of 100 more will reimburse me for that because that's a pretty clear-cut case of me not authorizing the transaction. I think that it's funny, and this is the question I wanted to sort of end on for this segment. You sort of talked about where's the right line for liability and where should it sit, and how much responsibility should consumers have. And we're going to talk about this more when we get to our unanswerable question. But just to sort of preview it,
we're always just thinking out loud here.
We're always thinking out loud. For as critical as I have been about the banks and EWS and what they've done with Zelle, I still don't know that I think we should really meaningfully change the liability or the rules around this, because I do think there is something good in terms of incentive alignment for having this line between authorized and unauthorized transactions. My critique, and this is why I'm generally supportive, I think, of what the CFPB is doing here and of this lawsuit, is I think there needs to be a lot more pressure constantly heaped on banks and fintech companies that when you offer these tools to customers, you are doing so in a thoughtful way. Yeah. You are offering responsible safeguards. You are providing ample consumer education, and you are not dicking around at all with the liability when there are clear-cut cases. Like the number of people who should be able to say, yeah, I was robbed. I gave my bank evidence of that, and they still wouldn't reimburse me the transactions. That number should be zero. It might not be that much higher than zero, but it should be zero. And the fact that
it should be 100% of 100%,
claims
that
exactly.
meet that standard.
They should all be reimbursed. And the fact that they're not, the fact that you can even find one example of that not being true, I think kind of gives the game away that banks haven't been good actors around this so far. So that's my hope for what changes. What's your sort of final take on this?
So when you brought up credit cards being a chainsaw, it reminded me that one of the CFPB's, I believe, earliest actions was to discuss how big banks were promoting credit cards on college campuses. And how the CFPB needed to say, hey, we think this is a more serious financial product than you are marketing it to. This can harm consumers, even if they're not really tricked, they're just not really fully informed and educated. And we just think it should be done a little differently. And yeah. And so it kind of reminds me of this thing too, right? Like the banks just were like, look at this product. It's so great. It's so easy. And then when consumers experienced harm related to the product, they were like, oh man, that's totally on you. I'm sorry. I just think like the line of like, I'm sorry, my consumers are stupid is just not the most like the winning argument at the end of the day. And then the other thing is the CFPB makes a really interesting argument. I guess it's possible this argument had been made before and I just hadn't noticed it. that you are responsible for the design of your things. Maybe not how all their use cases, but when you build a product and the product has certain weaknesses and people encounter harm for the weaknesses, you are both responsible for that harm and you are responsible for changing the product. And I hope that, I think Zelle is probably like a good product in the end. I think it was like really weirdly hard to pay people for a really long time until Venmo came around and showed there was a way that consumers could be taught how to pay people. There wasn't a lot of consumer education around that, though.
Yeah, well, and to your point, like Zelle did dramatically increase people's access to P2P, that like modern P2P. Yes. So there is for sure an argument that for all the problems, Zelle put a very useful tool in the hands of a lot more people, even more than Venmo and Cash App had.
And it didn't have to your point, it didn't have to be real time, but it was really good. It was good that Venmo existed to solve the problem of paying people not with cash or check. And then the banks also got in on that. But I think the responsibility around the way we design our product really matters. And we will be responsible for the harm that comes from poorly designed products is, I think, a really interesting argument that the CFPB is making as to determine the culpability here.
Yeah, I totally agree with that. And I think that particularly in the era of like digital financial services products, where it's like, this isn't a person interacting with another person in a branch where it's a matter of like training and employee incentives. This is like a thing we're going to build that can work autonomously without bank employees ever touching it. The requirements to design that thing safely and thoughtfully and not rush and not screw it up, like those incentives need to go up as we make these products more sort of autonomous and automated and like not the function of like living within a branch environment. Like I think product design has not historically been a regulatory concern in banking the same way, because bank products were really just like a financial construct that was then sold to you and serviced through a branch.
Yep.
When we think of products more as software, then we have to be much more thoughtful about the way the software is designed. And I would agree with you. I think it's good that the CFPB and other regulators are looking at product design as a avenue for like UDAP and for customer harm.
It came up in the Apple Goldman Sachs order as well, right? Product design is an important component, and even if you don't intend to hurt the consumer, even if the product design is just that you think it would be really cool if all the bills were processed on the first of the month, or there can still be harm that comes from that.
Right. No, I completely agree. All right, Kiah, here's my challenge to you. For our second story that we wanted to hit really quickly, this is in some ways an update to one that we've talked about a few times on the podcast. So can you run us through the updates about Loper Bright in like 5 minutes? Is that doable? Like how tight can you keep this segment?
I can talk really fast. I'm a famously fast talker.
You can. So you're a famously fast talker. All right,
I'm going to try to not talk about this, in part because we talked so long about the CFPB, and in part because I'm not an attorney or a lawyer. But I did want to surface, because we talked about both of these decisions or these cases when they were argued before the Supreme Court, and we have talked about them when the cases were decided. And so Loper Bright and Jarkesy are these two court cases where the Supreme Court kind of sided with industry and away from the administrative agencies. And so we are now seeing these court cases and the impacts of these decisions percolate into industry. So the first is that the Federal Reserve announced that they were going to change the way they conduct their stress test, or they assemble their stress tests. It's not fully clear what the change is going to be, but the Loper Bright decision is factoring into what the Fed called the evolving legal landscape and the changes to the framework of administrative law. So they announced that December 23rd. And then we saw a mention of Jarkesy in a legal argument that a community bank in Kansas submitted to a court as part of, arguing about the FDIC's ability to assess them a fine. And this bank is CBW. They received an enforcement action in December, it came out, I believe it was announced either right at the end of December or the beginning of January. And both Bank Reg Blog and our friend Jason Mikola have written about this argument itself. And without kind of getting too into the weeds, because in part, like one of the things about making arguments is that you're just trying like a bunch of different like arguments to see which one kind of works, which one is the most convincing. And so it's not to say that the FDIC will lose on this, but it's interesting to see that like someone is trying to make a legal argument to see if a court will buy it. And then in Fintech Business Weekly that came out on Sunday, Jason quotes Todd Baker, a senior fellow at Columbia, who says that the mention of the Jarkesy case by CBW is a test case of the limits of Jarkesy as it applies to the FDIC. And that ordinarily, the outcome should be clear that this argument will not work or should not work. But the removal of or the elimination of the administrative state actually means that we can't assign the success of this to zero. Like we have to kind of take these arguments seriously to see just what the legal landscape will look like as a result of these two decisions.
Well, that was very concisely explained. So thank you for that. No, it is really interesting. I mean, just to kind of maybe summarize this point, and I'm even less of a fake lawyer than you are, so I won't.
No, that was really painful, remembering the difference between Loper Bright and Jarkesy.
That's so funny. I don't think in terms of like case names. That's just not how my brain assigns meaning. So I have a very hard time remembering these ones. But, we've talked a lot about both these cases, right? And they both relate, as you said, to changes, I guess, weakening of the administrative state and the sort of deference paid to regulators, the deference paid to sort of longstanding procedural and administrative rules. So like all of that being weakened, basically, as you're describing with these examples, sort of creates a new canvas for everyone to paint on, right? And in this country, we like to give lawyers lots of opportunities to bill their clients. And so, in the case of CBW, they're trying to argue that Jarkesy sort of limits the FDIC's ability to do certain things. In the case of the Fed and stress testing and Loper Bright, they're trying to take sort of this new sort of weakened administrative state into consideration when they're designing stress tests. So I guess the takeaway from this is we are seeing both industry and regulators sort of proactively adjusting their approach to dealing with each other and to just sort of strategizing for the future, taking these cases and these decisions into account. What we don't know, and Kiah, correct me if I'm wrong, but what we don't know is, I mean, Todd sort of opined in Jason's piece a little bit about this. We just don't know, like, if these arguments are going to work, right? Like we can make our own judgments, probably not you and I, since we're not lawyers, but we can make our own judgments about like how valid the argument is that's being made. But whereas before the argument would have been like a straight up no, like don't even float that idea because that's stupid and completely in contradiction to established precedent. Now the doors are open for these arguments to be made. And I guess we're going to have to wait a couple years to see which, if any of these arguments work. I guess one question I want to turn back to you really fast. Do you find it interesting that, like in the case of the Fed and stress testing, that regulators are sort of proactively sort of trimming their sails or doing things differently in sort of expectation that these might be a problem? Like, to me, that's an area where even if the bank doesn't have to make the argument and have a judge agree with them, in some senses, they're winning because regulators are already kind of adjusting their approach proactively. Is that a fair way to think about that?
Yeah, one of the things that is interesting is we see a lot comment letter, requests for proposals. Like we see a lot, feedback is a really important aspect of rulemaking. And so in some regards, I'm not like, this isn't like the first time it's ever happened, but the application of the Fed stress tests and thinking about the ways, since CCAR has, formed and what CCAR was trying to do and why CCAR exists. And then to think that over the years, different, the BPI and the different banks have had to negotiate with the Fed over checking your math and resubmissions. And this is, really big time commitment for the banks, and we can argue about the utility of the test itself. If you completely miss including a 5% increase in interest rates in your stress test, and so it is interesting to think that I think what we're seeing is the terms of engagement are changing. The Fed did something to indicate that it is changing how it will engage. And I think that's like probably fine. If it was like this, it would be probably fine. But I guess the question that in what ways are they going to change the stress test? And why would, I kind of like trust the motivations of the Fed in this exercise. I don't always trust the motivations of the big banks, which is, I cover banks, right? Like I want them to be really successful, but the stress test came around for a really specific reason. And the exercise meant something because the industry had lost so much credibility in the financial crisis. And so I don't, while the Fed has opened itself up to comments, it's like, in what kind of comments are they going to get? What if they don't take the comments? And, in what ways do the big banks want to change this thing that I think should be hard for them? And that when you get the implicit guarantee of like being too big to fail, that has to kind of come with some stuff. And there's only like 8 or 10 or 12 CCAR firms now anyway, right? It's only $250 billion in assets. Mm-hmm. And so it's like, I don't know. It just seems like, I don't know if I love that 8 banks get to tell the Fed what kind of fitness test they want to run. You know what I mean?
I absolutely know what you mean. Yeah, I'm with you. And I think in particular, stuff like this, like I'm with you. I trust the Fed's motivations here.
Yeah, as an actor.
As an actor. And I also find that like the other thing with a lot of things, and stress tests are a good example of this, is it's really hard to tell when banks object to this stuff if they're objecting because they're being told to eat their vegetables, or if they're objecting because this is a thing that's materially going to harm their business or the U.S. economy. And I find this with a lot of regulatory stuff. They'll complain about like the costs of compliance and all this stuff. And it's like, look, like, just do your homework. You know what I mean? Like, I know it's hard. I know it's annoying. None of us like to do our homework, but like, do your homework and don't complain about it, versus other critiques that I think banks have of regulators, which are very fair, which is like, look, this is materially harming our business, our ability to serve our customers. Because of the role we play in the lives of our customers, it's harming the broader US or global economy. Like, there's a different set of arguments for more lax regulation or changes in regulation that I'm much more sympathetic to. But I do find that banks tend to weave those two arguments together in a way that makes them very hard to distinguish from each other. And as a result, I'm kind of naturally skeptical whenever a bank pushes back on regulation, even though there are very valid reasons to do so. So I would tend to agree. All right, Kiah, I think we've done a lot pretending to be lawyers for a second there. Why don't you introduce our potentially unanswerable question, which we've already teased pretty significantly. So I don't know if we spend a ton of time on this, but I do think it's worth kind of rehashing for a second.
Yeah, so this comes up as a theme in the CFPB Zelle order.
Yes.
And we can talk a little bit about how it comes up with FDIC insurance signage. But Alex, my question for you is, can you, either as the FDIC or a bank, disclaim or disclose your risk away? And when we, recalling what we were talking about with CFPB and Zelle, many banks, including the bank that I use, if I ever use Zelle, they're very obsessed with me like adding my address book because they really want me to only send money to my contacts. And then if I'm like, I don't know, paying like someone who did my nails or something over Zelle, they freak out about me sending money to someone I've never sent money to. And they make me go through several screens that say, once the money's gone, it's gone. You don't know this person. This could be a scam. And you have to hit affirmatively through every single one of these screens before I'm allowed to use Zelle.
Yeah.
And obviously they have done that because of complaints like this, right?
Yeah.
And my question, I actually did ask this during the CFPB press call, but there was like a really bad echo. So I'm actually not 100% sure what the like answer was. But can banks disclose? Is that like, are those 3 screens enough that a bank can say, like, we told a consumer we did our best and they still did it and we're not liable?
So this is a great question. And I like that you're connecting different strands of banking and fintech stories together to ask this question, because it does come up in different contexts in various places. But I guess my thought on this is that I think a reasonable neutral observer's answer to this question should be yes.
Okay.
Because I do think there is a level to which you sort of have to ask the question, and this comes up a lot with fraud and scams, right? At what point do we just have to go, there's nothing we can do to stop you. This is your money. If you're going to find a way to be tricked by this, you're going to do it. And the only recourse we have is to either call adult protective services, which is a thing that happens in the case particularly of like scams that target elderly consumers, or to close your account and to basically debank you because we don't think you're banking responsibly, or to warn you sufficiently and then do what you're telling us to do. And I think that there has to be some version of this where the answer is yes, we have appropriately warned, educated, disclosed, disclaimed our way out of liability. Because the flip side to not doing that is essentially to debank someone, which then gets you as a financial institution into a whole other heap of trouble, as we're seeing recently with everything going on in the crypto space. So, I think there has to be some level at which that's appropriate. I mean, it reminds me of the story that came out last year, which is still one of my, top 10 all-time favorite things I've learned about what's happening in banking and fintech, which is Revolut going to the extreme lengths of making customers take selfies that look like hostage videos, holding up a sign that they wrote saying, I understand that this is a scam. Revolut has warned me I'm not going to get my money back. I want to do it anyway. Taking a picture and submitting that before they do that. Now, I think that was really bad PR for Revolut. I think that that was probably not the most customer-friendly thing to do, certainly. But I can see where they're coming from, right? It's like, what do we have to do to make this clear both to our customers and to regulators that we did everything we could short of stopping someone from doing what they want to do with their money? So I think that's all very fair. Let me flip it around back to you, though, which is, let's use the FDIC example.
Are you going to explain how the FDIC example applies here?
Well, I'd like to just talk about it for a second, okay. Which is, has the FDIC appropriately disclosed and disclaimed liability for customers not having access to deposit insurance by publishing a consumer-facing bulletin to their website, which, as we all know, all consumers in the U.S. check on a daily basis? Did they do their appropriate amount of disclaiming?
I love that website. I loved the effort. Like, I loved what they were trying to do because, and I don't know, I hope I assume that the FDIC published that like earnestly and in good faith.
I'm sure.
Which then for it to be greeted with, who do you think is going to get this? Who do you think is going to read this? Who do you think is going to write about it? Just because you put it on your website where it explains deposit insurance and what it does and doesn't cover, doesn't mean you have fulfilled your doesn't mean that that's going to be sufficient to clear up the confusion around deposit insurance.
Yeah.
Right.
Yep.
But it was a nice try.
No, I think that's right. And I guess the other thing that it makes me think of is this is really a question of friction, right? Which is like disclosures and disclaimers and education and all of those screens that pop up before you try to send a Zelle to someone who you've never sent a Zelle to before. All of that essentially is working against the desire that the banks have, which is to make the experience smooth and friction-free, right? And so it's like, on the one hand, we have this incentive, which is to make this experience great. On the other hand, we have this incentive to make it abundantly clear if you're doing something dangerous that you're doing something dangerous, and we're not going to be liable for the damage that you cause if you go forward with this. And those two things sit at odds with each other. I think the thing that's interesting is the same thing actually applies to the FDIC as well, right? Like the FDIC, and you've said this before, they're too good at their jobs, right? Like they make bank failures frictionless. They make it so there's no interruption to customers, but the I guess consequences of that they need to wrestle with is people are too trusting of putting their money in places, and because of how good the FDIC is at this. And so I guess the question I have on that is like, both for regulators and for banks and fintech companies, what is the appropriate way to think about the balance there between friction and sort of adequate disclosures and helping people manage risk?
Is like, I mean, the question kind of is there any amount of disclosure that a Yada type or a Juno type could put on their website, put on their app, that would make
like if the FDIC had their way and could have been like in the design meetings with Yada going like, here's what your website's going to say, here's how your app's going to work. What could they have done that would have fixed
And what
this?
could they have said? Like what language could they have said on that website that's like, you could lose access to your money and the FDIC will only pay out if the underlying bank fails. You may not even know what the underlying bank is, but that's the only thing you get from this. And that's just got to be acceptable. So when you put your money, when you give us your money, we'll put it eventually at a bank and hopefully your name's with it. But we don't know. You don't know. There's no way for you to go check to the FDIC. And also you could lose, there is like a more than 0% chance that you would lose access to your money in a very series of crazy circumstances.
All right,
and then just to be like, and everyone's okay with that, right? Like everyone's like, yep, that's
what I want.
We disclose our risk away,
Well, so here's just because I love you asking like a practical question about how would you actually like do this? What's the appropriate level of disclosure? Here's a wild idea, and I'm not saying this is going to happen or even necessarily should, but it's just interesting hypothetical to think about. What if every time you linked a fintech app you were working with to your bank account in order to transfer money from that bank to the fintech app that you're using, or anytime you are setting up direct deposit that's going to a non-bank app of some kind, there is a mandatory disclosure, a screen that the consumer has to read and click through that essentially discloses what you just said. Like, hey, heads up, you are moving money into, you are connecting, you are connecting an FDIC insured bank into a non-FDIC insured financial technology application. Just so you know, this protection that you're used to with this bank doesn't apply if this institution fails. It still applies for the underlying bank. It does not apply in this case. Like, I wonder if we took this question seriously and using the infrastructure we have with like open banking and account linking, I wonder if you actually could come up with, because like the FDIC has this, they have signs, right? They have like actual physical signs that go up in bank branches, and there's whole pages of regulation.
I'm on the website right now, and apparently you can get those signs for free if you have an FDIC Connect account.
See, okay, you can order the signs.
I think these signs kind of suck. Like, I don't think they're useful, but for the most part, you see the sign in a bank, right?
Yeah. But like that was the idea, was like, we have this sign. It only goes up in banks that get it from us. We punish people who use this sign who don't have permission to use it. And it's a signal to people that like they can trust putting their money here. The problem has been historically that, and the FDIC has tried to crack down on this, but like the problem has been, hey, we can't screen every website in the world. And so if some fintech app decides to say this is insured by the FDIC, or they use language that's a little bit deceptive, or they use our logo without permission, there's really no way proactively that the FDIC can make sure that doesn't happen on any website. But I wonder if there are other, I almost use the word choke point, which is sort of a sensitive topic these days. But like, I wonder if there are other like points of control within the digital financial services ecosystem where the FDIC could say, hey, here's a spot where we would like to drop in a disclosure. And because we're the FDIC, you have to play ball with us. Like, I wonder if there's a way to modernize the signage and disclosure process so that people do see it when they need to see it. Does that make sense to you at all?
I think that, it's funny too, like, how would we force this? And FDIC tells all BaaS banks to update their contract language, and FDIC has rights to
knocks on Plaid and MX's door and says, hey, anytime you connect an account, if it's in this circumstance, we need to do this. That's technically possible. There's probably some bad idea or bad reason why this would be something we wouldn't want to do.
But I think the other thing too is that this kind of pretends like disclosures can solve the problem. And the problem can't be solved with disclosures. The problem is that consumers do not know what the FDIC does. Yeah. And again, were we talking about this before, during? People have confused what is a bank and what is not a bank. And so when this confusion exists, when these delineations aren't meaningful to consumers, why focus on fighting a question about disclosure? The problem isn't disclosures. The problem is that people don't know what a bank is. And so maybe the FDIC needs to update its sign, not so that it says, I'm looking at it right now, backed by the full faith and credit of the United States government, each depositor insured to at least $250,000. FDIC insurance only pays out if this bank, and then you can put bank name, fails. Up to $250,000. I don't know. Or the FDIC separately could run a website that says, hey, put in your name and social security number. Here's how much your insured deposits are that we have documentation on. And so if that amount of money that the FDIC says you're insured up to is the same amount of money that you have at all of your fintechs that put the money in a bank, then you're covered. But I just don't think that disclosures I don't think the FDIC can disclose its way out of its problem, because I don't think disclosures are the problem here.
Yeah, I think that's interesting. I mean, it's kind of two separate questions, right? One is, what does it take for people to actually not do risky things? And then the second question,
or to know that they're doing risky things.
To know what risk they're actually taking. To do the risky thing
on purpose.
Or then the separate question, which is the one you started with, is should there be a line at which we no longer assign liability if you've gone to a certain point with disclosures? And I think those are slightly different questions, because I do think, as I said before, I do think there is a line where past that, we shouldn't be assigning liability if you made it abundantly clear. I think P2P payments and other sort of real-time payments and scams, I think we're getting to the point where some banks and fintech companies are crossing that line, and we really shouldn't be holding them liable if someone's holding up a sign saying, I'm going to get scammed. I was talking to somebody about romance scams, which are really tragic, because these elderly people fall in love with someone they've never met, and then they have to give them money. And it's they cannot be talked out of sending their life savings to someone they've never met. They just can't be talked out of it. And there's nothing you can do. So I think there is a line where we shouldn't be assigning legal liability. But your question's a good one, which is, will disclosures by themselves really solve the underlying problem of people falling for these things? And I don't think they will, to your point. I do think there has to be a different way of doing that. And just as a side note, you and I have talked about this before, I love the idea of the FDIC operating a consumer-facing website where people can plug in their information and find out where the hell their deposits actually are. And
the FDIC could just function the way people think it functions.
Totally.
Right?
Well, it's
that's an idea.
It's not crazy. Well, and it's funny. We'll have to do a future episode about this, but I actually think one of the things federal banking regulators as a group perhaps should invest in is some really kick-ass consumer-facing website development and marketing, because I was thinking about this in the context of the CFPB's attempt to build a credit card comparison website, which you and I won't get into because I know you have lots of thoughts on that. We'll save that for a future episode. But there are enough examples, isolated examples of regulators being we need to talk to the people more, man. And they just don't have the heft or the ability to do that. And so I think that upping their game in that area across the board would be something that would also be interesting. Kiah, let's end with this. I said we're going to do some quick prognostication.
We've talked about 3 things for 45 minutes.
Yeah, I know. We didn't have a resolution that we were going to make Bank Nerd Corner shorter, so just calm down, people. I'm going to ask you 3 questions. As we said, I think, try on this podcast to focus on first principles and thinking about things not in terms of like what's been in the news or what's happened, but like just in terms of how this works and what the incentives are, like what is likely to happen or what should happen or what might happen. And I'll never forget the time you were talking to me about underwater bond values before SVB blew up. Like that type of thinking can be really useful to get a sense of where the industry is headed and what rocky shoals we might run into. So I want you to put that hat on, and I'm going to ask 3 questions. We're each going to give quick kind of lightning round answers to these. You ready?
Okay.
Question number 1. What's one specific thing that you think will happen in 2025 that will be significant for banks? Kiah Haslett.
Capital One deal to acquire Discover will be approved.
And your bet on this, which I'm sure you could probably go to the prediction markets and actually make some money on if you wanted to.
Absolutely. Dude, I am a serious journalist. What?
I'm just kidding. That was a joke. Was a joke. And Kiah, you forgot to mention before that these are your opinions, not the
these are just my thoughts and opinions.
Yeah. So this is all just for fun. We're just joking here. But tell me why, in a journalistic sense, you think that is likely to be approved.
I think I think it is important if it is approved because it would reflect that the federal banking agency heads have changed meaningfully enough that their orientation towards large bank M&A is one that they'll let at least one deal through. And it's not to say that if Capital One is successful, it's going to be a free-for-all, but it might be easier for PNC to make an acquisition. And we know that PNC wants to probably buy something and be more active. And so, I think that would indicate the sentiment has changed enough that big bank M&A is back on the table.
I like it. We should also note, just for sort of breaking news reasons, that Michael Barr, the vice chairman of bank supervision at the Federal Reserve, is going to be stepping down from his role as vice chairman of bank supervision.
That's correct.
Yep.
But he'll still be on the board.
He'll still be on the board, which means that there are limited choices unless someone else steps down for a new vice chair to be appointed. Michelle Bowman would be my guess. But anyway, all of that is just to say that we are going to have new heads of a lot of bank regulation in 2025. And I think you're right. And in fact, my answer to this question, lightning round, very quick, is also M&A oriented. I think that at least one fintech company is going to acquire a bank charter, which we saw happen back in, what was that, halcyon days of like 2020, 2021.
I wrote an article about this.
Yeah. There was a window of time where this was possible, and then that window slammed shut, as they tend to do. I think that window is back open. And I think from what I've heard, there are a number of later stage and maybe even earlier stage fintech companies, or even individuals from the fintech ecosystem, that are going to be looking to acquire a bank. And I think the objections to that will be a lot less than they were before. So that would be my guess. All right, Kiah, you ready for question number 2?
Yep.
What's one thing that you are worried about for banks in 2025?
So I think some of the economic policies that President Trump has proposed will have an inflationary impact on the economy. And I think it will be really interesting to see what the Fed does to counteract that if they are successful. And I think that if we have inflationary economic policies, interest rates can only do so much, right?
Yeah.
Yeah,
they haven't really come down that much, have they? So
really haven't.
No, we didn't really give ourselves a lot of room there. And also speaks to the earlier point I was making as it relates to the independence of the Federal Reserve. So we shall see. That'll be interesting and certainly very relevant for banks. Mine is more on the consumer balance sheet side. But the thing I'm worried about is I think both banks and fintech companies, and I think BNPL is a good example of this, have gotten too good at keeping their customers in a perpetual state of maximum debt.
Okay.
And I think it's going to backfire in some way.
In a recession?
Them. Well, I think a recession would certainly not help with that, right? But like my general sort of theory here is that we used to offer consumers these very blunt instruments for taking on debt. And so it was like, if you were like a credit card issuer, you would underwrite someone for a line of credit. You would maybe increase that line over time, but you had quite a bit of exposure that you had to manage, and you had to be really good at managing that exposure. And then if there was something that happened either to you as an institution or to your region of the country or to the entire country or the economy, your assumptions about that could be bad, and your sort of risk would explode, right? And so credit risk was sort of, banks would take big credit risk and then they would manage that risk carefully. I think what's happened, and again, I think BNPL versus credit cards is a good example of this, but I don't think it's the only one, is that I think we've sort of redesigned products so that we are taking less risk. And so if you think about like BNPL, like BNPL loans are all like $200, $300, $400. It's a 6-week term. If any one customer blows up, or even if like the economy goes into a recession, there isn't some like massive amount of exposure that BNPL lenders have, right? They can just turn off the faucet, and like their business isn't going to be very good because they're not making any loans, but like they're also not going to be like, having this massive risk that they then have to sort of unwind and deal with. I think that's good for lenders, but I think what that has meant for consumers is where in the old days you might have like said, hey, you probably could handle a bigger credit line on your credit card, but because we don't want to take the downside risk of having that greater exposure, we're going to be sort of conservative in our lending. We're not going to give you maybe as much credit as you might want, or as we and merchants might want you to have. With BNPL, because that cliff doesn't exist, that like large exposure risk doesn't exist in the same way, I think we're driving consumers right up to the edge of the cliff and saying, like, we're going to stuff you to the gills with every last ounce of credit availability that you can handle transactionally whenever you want it. And we want you to maximize that as much as possible. We see this in auto lending. We see it in unsecured personal lending. And so I think that in 2025, maybe 2026, we'll see what the timeline looks like. I don't think we're going to see like, oh my God, banks and fintech companies' lending portfolios are exploding because all these bad things happen. I actually don't think that's going to happen. But I do think that consumers are going to sort of wake up to a degree and realize their financial goals have been derailed by basically keeping the maximum amount of debt that they can safely handle, like cranked up to 10 at all times. And like that overheating isn't going to impact bank and fintech companies' portfolios. It's going to impact consumers' balance sheets and the way they think about their finances. And I think there will be a backlash in some form to that trend.
I can buy that. I will say that the thing that I was maybe optimistic about is that I think credit quality is going to stay good in 2025 at banks. And so, but I think, buy now, pay later is really interesting because it's famously not a bank. Not very many banks are active in this space. Affirm and Klarna are not banks. They might have lines of credit from banks. And so maybe there's a little bit of stress there, but it sounds like you think the lenders themselves will be fine.
I do.
But that the consumer will have the like the weight of 1,000 like buy now, pay later payments coming out of their checking account. Yeah.
I mean, I think you're exactly right. I mean, I agree. So the last question was, what are you optimistic about in 2025? And I'm with you on the credit quality one, right? Like, I actually think banks have been pretty careful about credit quality stuff. And I think even like the non-bank lending stuff, I mean, private credit is kind of its own whole world that I don't fully understand or wrap my head around. So like, I'll leave private credit alone, but like for risk-weighted assets that banks have, for the lending that fintech companies are doing directly to businesses or customers, I actually don't really see any like massive ticking time bombs out there. Even like indirect auto and subprime auto is probably the worst, at least on the consumer side. And even that one has been relatively stable. It's hot. It's probably too hot, but it's not like blowing up. So I think you're right. And I think that's actually a good one to be optimistic about. I don't think that's going to be a problem, even if recession or sort of economy
inflation
problems sort of manifest themselves, which is very possible. All right. Can I give you my optimistic thing? And you might not be surprised reading my newsletter. I'm a big fan of open banking, but I genuinely think that banks are going to benefit hugely from open banking soon. And despite BPI suing the CFPB to quote unquote stop the open banking rule, I think what banks really want is the ability to charge when they're providing access to their data. I think they have a decent chance of getting that now that the administration is changing over. And I think there will be some changes to open banking and the rules around it. But I think open banking makes too much sense for everybody to go away or to recede. And I actually think banks are the big party that has not gotten nearly enough value out of it, but are going to get it soon. And cash flow underwriting is probably the first place we're going to see that. So that's my little bit of optimism for 2025.
Well, I think we have an open banking topic to talk about briefly, which is that you dabbled into some personal financial management that is made possible by open banking, which is your new foray into the budgeting software. You Need a Budget, which you've heard me talk about before.
I have. In fact, I think, Kiah, and this is where I get to apologize to you, I think I might have mocked you for being a part of a cult as it relates to YNAB, because YNAB has some pretty enthusiastic users.
I don't think I was talking about it enough. I really feel like I could talk about it a lot more. And now that you use YNAB, I have reasons to talk about it too. I know.
This is like a whole new chapter of our relationship. So yes, the short story here is that I, over the holiday break, came to the realization that my sort of prior approach to budgeting, which I will defend, by the way, and say that in a simpler time in my life, my approach to budgeting, just sort of keeping things in my head, worked wonderfully. But as you add layers of complexion and complication into your life, namely being married and having kids, what I have found is that, particularly as your kids get older, and kids are really expensive, especially as they get older, it's becoming increasingly difficult to keep track of everything that's happening from a finances perspective. And so, mostly at your recommendation, but also because I had the opportunity to interview Jesse, the CEO of YNAB, on the podcast, and found the interview to be really compelling. He sort of outlined YNAB's philosophy from a product perspective. He also talked a lot, by the way, about YNAB as a business and what he wants it to be and what he doesn't want it to be. And I found that also really encouraging, because it's not a grow it at all costs. We have to get to 100 million users. We don't care about profitability. We're just trying to grow. Like, YNAB is a very slow growing, very long standing, very reasonably run company. I'll give you an example of this, Kiah. This is the only app I've signed up for in my recent memory, maybe ever, that allowed me to get full access to the product as a trial without plugging in my credit card information, which is amazing, right? Because almost every other app, even PFM apps and budgeting apps and fintech apps, they're like, yeah, free trial, but plug in your credit card. And then the hope is, we want you to get use out of the software, but if you don't even use the software, but you forget to cancel the subscription, we'll still benefit from that. YNAB doesn't want to do that. They just let me have full access to their very expensive software, or I'm a cost to them, for free for the trial period. And it's been great. I have been sort of working with my wife to get all of our budget categories put in place.
Yeah, the categories.
One of the philosophies of YNAB is that it's all of your money should have a job, right?
Yeah,
all of your
every
money
dollar has a job.
Every dollar gets a job. And so I've been assigning money to different categories. And I will say, one of the things about YNAB that's interesting is they really emphasize that every dollar should have a job, including dollars for things that you know are coming in the future, but that aren't recurring in a way that you might think about from a budget standpoint. So like, my car insurance bill is due twice a year, right? And it's a pretty big number, and I can reasonably estimate what it's going to be and when it's going to be due, but I never budget for it, right? Like, that's just not something the human mind was really designed to do.
I've been using YNAB for 3 years, so that I have this large chunk of money coming out of my budget every 6 months, and I've never budgeted for it. I'm just like, I don't even understand. I don't even understand what I'm saying.
Right. No, yeah, it's like seeing how the other half lives here. So I think that's been really interesting. I did have a couple of observations I wanted to share with you as a new YNAB user that I'd like to get your reaction to. The first one is, I'm very curious, and maybe we'll have to have Jesse on to talk about this too, but I'm very curious about the way that household finances work versus individual finances. Because there's a functionality in YNAB that's like YNAB Teammates or something. I can't quite remember what it's called. but it's basically like you can share your budget with other people and they can share their budgets with you. And you can share your YNAB account, right? So my initial idea was with my wife, hey, like, I want her to have YNAB on her phone. I want us to be sort of budgeting together. And when a new transaction comes in, I almost want it to be a race between the two of us to like categorize it. You gotta
check the budget before you spend the money. Sometimes you're not spending money next to each other.
Yeah, exactly. Like I want all of that. I want us to be on the same page. So I did that. And what I realized, Kiah, that I thought was fascinating was YNAB's default assumption for like shared finances seems to be that my wife would have her own separate finances and budget. And then we would like in a loosely coupled way sort of permission each other to see the other person's budgets. So we would have our independent balance sheets, independent budgets with like the ability to share and like get visibility into each other's budgets and maybe share some categories. Very reasonable assumption. What's interesting to me is that's not how my wife and I manage our finances. We have one checking account. We've combined all our finances together.
Oh, crazy.
And I guess my question for you, Kiah, is that weird?
I mean,
are we weird?
I've been single for the entire time I've been on this podcast, so I'm maybe not the right person to ask. I will say that I'm understanding that there's not like one way for couples to manage their finances. I know that a very common one is that there's a shared account and then where money is shared expenses are deposited, and then everyone has their own money on the side. I love seeing on Venmo couples paying like each other. That's just got to be that's the weirdest thing. I don't know what those conversations are like.
I think
but
so
then
too.
It's funny to think that like, so, there's 1,000 different ways to probably structure household finances. So there's probably like a bunch of different ways that YNAB should be used. And I guess I hadn't realized that you would have your own budgets and then have a shared budget versus like you guys just share a login and it's like you guys are on the same Facebook account.
Well, and so that's what budget. We did. So that's what we did. So like after I realized that's the way it's designed, I was like, oh, okay, so we should just be sharing a login. And so then I had her log out and she just logged into mine, and that seems to work great. And so we solved that problem. But I thought that was an interesting little window into like, maybe we're a little unusual relative to others. I have heard that there's more of a trend these days towards keeping your money separate and then finding like combined ways. To me, that seems really weird, but I might be the weird one. So that's one. Another one that I was curious about, and I very curious to know how you handle this, is so every dollar has to have a job thing, right? Okay, so I'm categorizing
I have my budget open right now, and it's like the first of it's like very early in the month, so I haven't overspent anything.
Well, that must be nice. So I will say, by the way,
crazy in my budget.
Well, me too. And in fact, December was so crazy for us budgeting wise that it spilled over into January. And so what we're doing is we're using January as a test month to see where we spend. Yeah. And then we're going to try to more accurately assign categories for February. So February is kind of our first actual month. But the one thing I noticed is there are certain transactions, because all of this is linked, as you said, through open banking. So they use Plaid, they use MX, they use a number of different aggregators. You connect your accounts and then it pulls the transactions in and you sort of reconcile them as they come in, right?
Yes.
Some transactions, like the gas station, for example, are very easy. Like, that's gas. I can easily do that one. I got to say, other ones, not so easy, because like Amazon, we buy a lot of different things from Amazon, and some of it is fun. Some of it is household necessities. Sometimes it's groceries. Like, there's a lot of different categories that combine with Amazon. And I don't really want to create like an black box Amazon budget, because that's sort of like, Congress approving like appropriations for like the military where they don't even know what the money's being spent on. Like, I kind of want better line item management than just having a black ops Amazon budget where just money goes in and I don't know what it's being spent on. But Amazon, it sells too much stuff. Target is kind of the same way. I can't do this. So the only answer I've come up with is, and I talked to my wife about this and she sort of scoffed at me, but like, I was like, can we portion out our purchases from Amazon and Target so that like, when you go to Amazon this time, it's just household things and we can categorize that as a household transaction? How do you do this?
Sorry, this feels like a very specific conversation that everyone has to listen to.
We're having some budgeting talk at the end here, but like, let's just do it on the podcast.
I split transactions. If I go to Costco and I buy some stuff is shopping and some stuff is grocery, I just look at the list. I round I've roughly figured out what was grocery. And then in YNAB, you can just split the transaction and be like, same as if I went out to eat with 5 friends and 4 of them, because they love me and want me to have the credit card points, they let me pay. I would classify that transaction as dining out 1/5, and that would debit my dining out category. And then I would debit personal reimbursements, which is a category I've set up. And then when they pay me back on Venmo and then I transfer that money to my bank account, I would try and classify that transaction as a personal reimbursement expense. So then the line item zeroes out. I would try not to make the budget is supposed to make your financial life easier.
That's what I
do not make it harder. Do not make it harder.
I didn't know that you could split the transactions.
You can split transactions.
That's new information to me. Okay.
Yes.
Okay.
Yeah, you can split when you add a transaction. If instead of assigning a category right away, you click down. It says split.
Okay.
You can also add emojis to your budget. This is a really important thing. You can add emojis to your budget.
Oh,
so
I know.
That's
that.
good.
I know. My wife's excited about that.
And Alex, you are the second person who over Christmas subscribed to YNAB because I have talked about it. And again, I just want to, this is not a YNAB thing. YNAB's not a sponsor of you. I
not
pay
a sponsor
YNAB,
of the podcast. Yep.
But when I think about YNAB, what I think about is one, open banking. My data had its value. And I did not understand the value of my data until YNAB showed me how I could use it. 2, YNAB changed my relationship to money. And as a bank reporter who had covered banks for more than a decade and who had so much anxiety about money and felt so nihilistic about debt, to receive YNAB and for someone to say, we care about the problems you have with money. And the problem isn't necessarily that you don't have enough or whatever. The problem is that your money worries you and you feel out of control with your money. And these are emotions that the dollar sign itself can't solve.
Right.
Your money is just too hard and it's taking up too much space in your brain and you're thinking about it too much. And those thoughts are bad.
You feel out of control. Yeah.
And so and that's what I told my friend who also signed up for YNAB is she feels anxious about money because of growing up. So she, she was aggressively saving and she had a lot of guilt about spending money. Or especially on something like a vacation, right?
Sure.
And you know me, I love to travel, but I got the points, so I know. And so I told her that YNAB hopefully will help you help you understand your money, but also it will help you stop feeling guilty about spending money that you have assigned into that category, right? And so that
works
whole
both
permission
ways,
structure is so important, and so that's use whatever PFM. I like YNAB. YNAB works for me. And we've talked about how PFM, there's probably only about 20% of the population really wants to do this at any one point in time.
Yeah.
But don't make your budget harder than it needs to be. Do not stress out about this budget. You're not the first person to buy things from Amazon that are groceries and clothing.
Well, I figured there was a solution to this problem. So I wanted to ask you. No, I think it's really interesting. I also think that, and it's funny, I talked to Jesse about this on the podcast. Folks who are listening can go back and listen to that episode if they want. It's really interesting. But, the other thing that's interesting is just how YNAB specifically and how this category has evolved as technology has improved too, right? Because for a while, it's hey, here's a philosophy. We built a spreadsheet around it. Then we built a website around it. Then we built an app around it. Then we added transaction categorization and open banking. So it's these products evolve as more things get unlocked. I actually think one of the really interesting ones, and it would solve my Amazon Target problem in a more elegant way, Kiah, is I actually think there's a way, or there will be soon, for me to permission access to my Amazon account and my Target account and my Walmart account and all these other ones.
Yeah,
so that YNAB could look at on a transaction level, on an item level, what I'm buying from Amazon and could auto-categorize those appropriately.
That would be interesting because YNAB right now connects to our banks. It does not connect to our Amazon. So the reason why you don't have that information is because your bank doesn't know what you bought.
That's right. Well, and Amazon goes way out of their way to make it hard for banks to understand what it is I'm spending there, right? So I think the enemy here that I'm identifying is Amazon, who wants me to just have
that's what they did.
Seriously, they want me to have just this unlimited Amazon budget and not think about my Amazon purchases the same way I think about the rest of my budget. And they intentionally do things to make it harder for me to sort of contextualize how much money I'm spending on Amazon. I'm very curious about how technology will sort of push back on that and will allow banks and fintech companies like YNAB to do a better job helping us keep track of it. Kind of ties into my prediction about consumers feeling a little out of control from a debt perspective. Like, I think we're going to see a resurgence in interest in this sort of category of fintech. And I'm glad that these products exist. I mean, we don't do free advertising on Bank Nerd Corner for the most part, but YNAB.
If you
YNAB
think
gets
about
grandfathered
YNAB
in.
from this conversation, please my referral link and not Alex's referral link.
That's true. That's true. This is like one of those things where it's kind of like, I don't want to use the word pyramid scheme because it's a good thing, not a bad thing, but like this is like the person at the top should benefit.
Exactly,
and that's Kiah. So like, if they come to me, Kiah, for a referral, I will give them to you. You get the referral code. We'll account for it appropriately.
I can't believe it only took me 2 years of being on this podcast for you to sign up for YNAB.
Now, I will say you're going to have a way harder time getting me on board with your credit card rewards points, whatever. But I do think if we can categorize the last couple of years of Bank Nerd Corner and our friendship generally, it's that you say something, I'm like, no, that's crazy. And then you just wear me down to the point where I'm like, okay, I'm ready to give this a try. So congratulations on that victory. I do deeply appreciate your guidance on this. And as always, I very much appreciate the opportunity to do more Bank Nerd Corner with you. We will be back in the future with another episode. Kiah, thank you so much.
Yeah. Happy New Year.
Happy New Year.